Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. So what's been going on in the M&A market, the private equity market, with stock markets at what seemed up until some recent fallbacks, an all-time high, lots of money, low interest rates. I just thought I'd check in with a friend of mine, Mark Borkowski, who is the president of Mercantile Mergers and Acquisitions Corporation, a company here in Toronto. He's run it for 2 decades almost, I think, Mark.
34 years.
Really, 34 years.
34
and he advises,
it's going to be 35 in February.
He advises companies and investors in acquisitions, and he's obviously extremely well known in the industry and well educated on what's going on in the industry. And so I thought it would be really helpful to check in with him and find out what's going on with the markets, particularly as it pertains to mergers and acquisitions, financings, investment opportunities, private equity, et cetera. Mark, welcome to our show. How are you doing today?
I'm fantastic. Brian, thank you for having me on your show. As you can see, I'm wearing orange in recognition of our Indigenous population, and I've acquired a pair of orange cufflinks. I'm a collector of cufflinks. I have enough cufflinks to fill a museum. Before we get started,
how many cufflinks do you have?
A little over 300 pair.
300
pairs. I buy and trade and sell. It's a hobby. I've worn French cuffs since I think I was in grade 1. Private school, we wore French cuff. Gentlemen wore French cuff.
So I've got a bunch of French cuffs shirts, and some people are saying that the time for them is over because people are not wearing ties and suits anymore.
Well, they're not wearing ties, they're not wearing suits, but you can still wear You can wear a nice French cuff shirt, without a tie. I'm wearing a tie this morning, an orange tie, of course. But yes, and if you need some cufflinks,
you're the place to go. Awesome. Good.
Exactly. Brian, before we get started, I've nominated you for the Globe and Mail Changemaker Award. There's going to be 50 changemakers named this year, like last year, of people who've made an impact in society, in Canadian society. So I want to nominate you for the Changemaker Award. I want our listeners and viewers to do the same. They can go to tgam.ca/changemaker to nominate Brian Crombie. tgam.ca/changemaker. Please nominate Brian Crombie. Brian, let's talk mergers and acquisitions.
That's so kind of you. That's so kind of you. Thank you very much, Mark. I really appreciate it.
Thank you. You deserve it. You are a change maker. Your guests, the impact you've made on society, Canadian society, is pretty significant.
Well, it's very kind of you. Thank you so much. I think you're a change maker because you've been changing, businesses and financings for 34 years.
34, almost 35. So I'm involved in the sale of privately, mid-market private companies who are sold to strategic buyers, these days, private equity buyers. The market, Brian, is frothing. Never in the history of the world have we seen as acquisitive a market as we're currently seeing. Lots and lots and lots of money and buyers seeking acquisitions. Nothing to buy. I mean, the number of standalone private market, mid-market businesses are very few. There are private equity firms, strategic buyers, family offices, endowments, high net worth individuals, people looking to acquire businesses. Why? Interest rates have never been this low. Brian, in your lifetime, in my lifetime, in history, can you remember interest rates being this low?
Not this low, and certainly not this low for this long.
Not this low for this long. So that creates an acquisitive opportunity. People want to acquire because interest rates are very low, and growing organically in these very difficult times has become a very big challenge. Can't growing your company by 2 to 3%. Better to make a strategic acquisition of a company related to your business, or from the standpoint of a return on investment. Private companies, for the most part, even if they're earning 10%, call it earnings before interest, taxes, and depreciation, still probably have a 20, maybe 25 or 30% return on equity. That's a great investment. I mean, keeping your money in term deposits or in other instruments is less than 2-3%. Private companies are very profitable for the most part.
Why is that?
Why is that? I mean, return on equity in companies' businesses, as I say, can return 20, 25, 30 or more % on return on equity. Why do private business owners get very wealthy? They have 20 to 25, 30 plus returns on their investment. So being in private business is a great place to be. It's a great investment. Therefore, companies looking to acquire more of these companies because there are very good returns to be had in private mid-market companies.
So let's explore a bunch of these different issues. How much?
Yes.
Why is there so much capital washing around the market? Why interest rates so low for so long? Why private companies are so profitable, et cetera? We're going to take a break for some messages and come back in just a minute with Mark Borkowski to explore these issues in greater detail. Stay with us, everybody. Welcome back to the Briancrombie Radio Hour on Saga 960. We're chatting tonight with the president of the Mercantile Mergers and Acquisitions Corp, Mark Borkowski, who is 34 years in business, expert at mergers and acquisitions, about financings, about private companies, et cetera. And we're talking about the market and why it's so frothy. Mark, you said it was very frothy. There's lots of capital. Why is there so much capital? If there's so much opportunity to invest in the stock market and in real estate, interest rates are low. Why does that lead to a whole bunch of capital looking for private investment opportunities?
Private companies, mid-market companies get a better return than you can get in real estate or you can get on the stock market. As I've said, private companies' average return on equity will be 15, 20, 25, 40% return on equity. In the stock market, you may, depending on circumstance, get a single-digit return. So there's a real push to invest in a great asset class, which are private companies.
Okay, so let's hold on. So
go ahead.
Stock market return, you say, is in single digits. Cap rates,
most part.
Cap rates on a lot of real estate investments today are similarly in single digits.
Correct.
And the leveraged IRR, which is what a lot of real estate people look at, might be in double digits or getting close to 20%, but it's still the unlevered return is in the single digit kind of range. If you're investing in a GIC or any other kind of a bond, you're in the low single digits. Frankly, sometimes it looks like it's almost zero that you're getting rewarded for that investment.
Correct.
Why would the investment in private businesses be so much better? Is it that there's lack of competition? Is it inherently more profitable? Why the disconnect between real estate, as an example, or the stock market that are both in single digits and private companies?
Private companies create new wealth. Manufacturing companies create wealth. The returns historically have been significantly better. The difficulty, of course, is that finding a private company to invest in or to acquire is pretty scarce. There's lots of real estate, lots of stocks you can choose from, but there's a very limited number of private companies that are available. However, that's changing. Valuations have become also very frothy. Where's the money coming from, Brian? Pension funds, insurance funds, endowments. We're all investing in our pension funds and our insurance funds, and these funds have to deploy their capital. The private equity funds manage these funds. So this capital is available and nowhere to go. They're investing in real estate. They're investing in, of course, in real estate, but the returns are significantly better in investing in private companies. Private companies that are well managed, as I said, we can see returns on a return on equity of 20 to maybe 40% or better. So the same applies right now to venture capital. Early stage companies that will return enormous returns. It's risky, but there's a lot of capital looking for these projects. And the beautiful part of it all is that there's a new entrepreneurial culture being launched in North America. People are starting new businesses. The work that's being done at Mars, which is the government-sponsored technology center in Toronto, they're launching all of these great technology companies. And these technology companies are creating new wealth. They're hiring talented people, graduates in engineering, graduates in computer science. high level positions, there is a surge. There is a restart taking place. What's discouraging, of course, is government regulations and some of the other negative forces, but it's happening.
Now, there used to be a belief that you could start a business, particularly a biotech or a specialty pharmaceutical or a pharmaceutical, a scientifically oriented business in Canada, but you couldn't get enough capital to grow it. And so you had to go to the United States to get the capital to grow it. Is that still the case?
That is changing. There are probably, I would say, 41, possibly 42 Canadian-based venture capital firms alone. There's somewhere upwards of a couple hundred Canadian private equity firms. Now, let me qualify that. There are a lot of private equity firms that say they're private equity firms. Many of these groups are trying to do what we call a leveraged buyout. In other words, they want to buy the company with the vendor's money, with the seller's money. So they borrow a little bit of money and they try to load the company up with a lot of debt. It's not good because that company, of course, will be restricted in growth by growing a small percentage every year. So the ideal situation is having these companies bought by large organizations that come to the table with significant cash. That is the incentive now for these company sellers to sell. An average mid-market company here, let's say a company that does a minimum of $2 million of profit, EBITDA, earnings before interest, taxes, and depreciation profit, 2 to 10 or anything better, they will get an average of 1, maybe 2 inquiries a month from a competitor, a strategic buyer, a private equity group saying, sell us your company. In the past, these people held out. Today, with values being higher, people are saying, better take my chips off the table. So there is a new dimension. It's changing. Lots of buyers, still not enough to buy.
Okay, so let's talk about valuation. So you're describing some of the mid-market companies as having EBITDA, earnings before interest and tax of
amortization.
Okay, so EBITDA between $2 and $10 million.
Yes, that's mid-market in Canada.
So if you're earning free cash flow of between $2 and $10 million, what would someone pay for that? What kind of multiple could you get on that today?
Depending on the industry, you're looking at a starting rate of probably at the very low end of 4 times EBITDA. And higher, 5 to 7 for companies that might be over $5 million of EBITDA or better. That's risen by probably 1 multiple point in the last 2 years. So where we were paying 5, today they might be paying 6 times. So a company earning $2 million of EBITDA profit will probably sell for $12 million. They'll have to leave some working capital in the business. And remember, the objective for these people today is to use the capital gains exemption. Companies, all company sellers, if they haven't used their small business capital gains exemption, have the first $850,000 tax-free. If they're 2 shareholders, it's $850 times 2. It can be as many as 5 people. So doing a share deal at the moment with the very, very advantageous capital gains exemption makes it very interesting for people to sell. That's a pretty good valuation, 5 times, 6 times. And in biotech opportunities, it'll be much higher. I spoke to a Chicago-based private equity firm on Friday, and because the market is so hot, they are selling a distribution business of hydraulic products of a mid-market company that they acquired 4 years ago. And these private equity groups don't keep these companies very long. They buy them, they make them efficient, they recapitalize them, they change some of the players in the business, they get rid of the bad ones, they will turn it over. They have what's in the US today considered as auctions. They will have 100 proposals. They were looking at a proposal, and this is hard to believe, but can be verified, 44 times EBITDA profit by a competitor that needed this company to add something that would give them further benefit. 44 times EBITDA. So let's suppose they were earning 2 times $2 million times 44. What a score. So company sellers today are saying, why should I continue? These buyers, these very sophisticated buyers, these private equity firms are pretty sharp guys. These are Harvard, Yale, MIT, Sloan MBAs, engineers that come in and reposition these companies. The only downside is that in some cases, they load the companies up with too much debt.
Yeah, so I saw a
That's-
study that I think was done by McKinsey of Blackstone, KKR, et cetera, a bunch of the big private equity firms. And it suggested that 80% of the value of what they created in the new companies they bought came from just leveraging up. And only a small amount came through, cost restructuring or efficiency and things like that. And so therefore, while you criticize some people for being leveraged buyout artists, in reality, a lot of these private equity, the biggest private equity groups still are leveraged buyout artists.
Absolutely. I mean, LBOs are a fact of life. So they do make a great return. Look, if you're borrowing equity at, pick a number, 10, 11, 12%, and you're getting a 30 or 40% return on equity, it's a huge score for all involved. The issue, of course, becomes the principles of the company that are selling. Are they comfortable in having their business highly levered? Because in most cases, all of these deals are not all cash deals. An average mid-market transaction will probably be, let's call it 5 times EBITDA. They will likely pay between 70 and maybe 80% cash on closing. They will ask a company owner to take back maybe 15 or 20% in a vendor take back note. Let's call it as simple as that. That note will be subordinated to the bank. So they'll borrow money from a bank. They'll be in first position. The owner of that company will have a note. Now, there's a big issue, of course. The vast majority of companies that we're talking to have been affected by COVID, Brian. So there is all these sellers say, well, 2019 was my very best year. I had a great year in 2019. 2020, wow. Revenue dropped by 35%. EBITDA dropped by 45%. But I want 2019 value. So the only solution is there's an earnout. So you say, well, if you believe and we believe, then what we'll do is we'll give you a certain portion of cash. We'll give you a small vendor take back note, but a portion will be based on an earnout or if come. In other words, if we earn it, you get it. 3 types of earnouts. And the worst one, of course, is let's share profit at the bottom. So a potential buyer can load the company up with all kinds of management and expenses, and the seller doesn't get anything. Another approach is to take a percentage of what we call gross profit. A percentage of gross profit, unfortunately, very difficult to manage. A lot of accounting, a lot of auditing. The easiest way is to say, okay, we've given you some cash on closing. We've taken a small vendor take back note. We're going to share the risk with you. We'll give you an earnout. It'll be a royalty on revenue. So if revenue went from 25 million to 31 million, you're going to get a royalty on that for some limited period of time. Usually there's a floor. Sometimes there's a floor and a ceiling. However, believers that believe in their business that are going to stay around will see that value or exceed it.
What are you seeing in regards to how long people think they're going to get back to the 2019 values? I've seen some hotels, feasibility studies, for an example, that think they're not going to get back to 2019 average daily room rates until 2023 or 2024. So it's almost like 5 years of lost revenue growth, and obviously a dip in the middle because of COVID. But I've seen some restaurants, particularly restaurants that are smaller and so therefore haven't been negatively impacted by capacity restraints as much and have got big patios, that say, frankly, this last summer was one of the best couple of months they've ever had. And it's equal to, if not exceeding, what they've done in prior years. Manufacturing companies have been commenting that they're up and running, but they just can't get supply because of all of the global supply chains that have been completely messed up, and that there's still, container ships that are not being able to dock. So what are people saying in regards to how long it takes to get back?
The people that I'm dealing with, for the most part, want 2019. 2020 was a write-off. 2021 might have had a bit of an increase. We're talking about 2022, 2023, and 2024 for most companies to come back to those levels. However, most of these people are pretty exhausted. They're tired of having lived through these changes. They've become sellers. But Brian, you raised an issue about logistics, shipping. Last year, it cost $5,200 to ship a container from China to Toronto. This year, from May forward, it's $26,000. And they can't get supply. There's going to be a shortage of all kinds of consumer products coming out of China this December. it's going to be a pretty lean Christmas. So a lot of these companies aren't going to bounce back. Importers of products, particularly those bringing in product from the Orient, are going to be affected pretty strongly.
That's fascinating. $5,000 to $20-something thousand increase in the cost of shipping a container. Why?
Why? The Chinese government own the shipping companies. The Chinese government have taken over all logistics, all shipping companies, and so they dictate the price at the moment. We need their product. By the way, prices for products have gone up. Wait till you see the new price lists for Chinese products coming into North America. You're going to be pretty shocked. There are Canadian importers now who are maybe doing some manufacturing, saying, you know what, we can now manufacture in Canada. The differential for a lot of consumer products, and I'm talking even about apparel, is about 10 to 12% different. I can manufacture now in Canada, maybe 10 to 12%, a little bit higher than I can from China. I don't want to be beholden to China anymore. However, they still rule the world in terms of product. We're still buying. Unfortunately, people can't bring in product. There were 32 ships at the port of Los Angeles that couldn't land because, number one, strike, capacity, no employees, dock workers not working, the same things at the Port of Montreal, Port of Toronto. All of these people are on unemployment, CERB, and COVID relief. Products not coming in. Companies obviously very frustrated. Christmas is going to be a little colder this year.
You know, it's interesting. I was chatting with a gentleman just last week at lunch who runs a fashion retailing company. And he was saying that jeans to get shipped from Asia to Canada is $10 for the jeans. And then if they get shipped from an Amazon warehouse to your house, it's another $10. So he says, if I can actually buy and distribute them, I've got $20 that I can probably save by getting rid of those two shipping.
It sounds great. It sounds great. You know, in description, making it work, of course, is very different. You've got to have the product. You can't sell it if you don't have it. Amazon have the product. Walmart have the product, or will have a lot of the product. So a lot of these groups that want to distribute on their own, they haven't got access to these products at the moment.
We're chatting tonight with Mark Borkowski. He's the president of Mercantile M&A. We're going to take a break and come back in just a minute and talk more about different markets that you can invest in and what's happening in them all. Stay with us. Welcome back to the Brian Crombie Radio Hour on Saga Night 60. We're having a chat today with Mark Borkowski. He is the president of Mercantile Mergers and Acquisitions Corp in Toronto. He's run that company for the last 34 years, almost 35 years, and he's well-versed in what's going on in the market. Mark, I think, can we try to set the scene a little bit for everyone? And let's talk about different markets. So, you know, we all know about the stock market. And, yes. And the stock market is something that you can invest in, you know, through you're directly through an online brokerage or through a licensed advisor, et cetera. What are some of the other markets? Tell me, I've heard about something called a CPC market. Can you explain what a CPC market is?
Well, these are all public vehicles that are made available through brokers. You know, so I deal with private companies. Anything on the public market is not in my domain. So again, mergers and acquisitions, for the most part, is done in the private markets. The public markets are a whole different world. You know, and that's not an area where number one, I'm not a qualified broker. I'm not a registered broker. We deal with private companies, so I have a private company registration.
Right. And what's a private company registration?
We're registered under the Mergers and Acquisitions Brokers Act. So that takes a very simple registration. However, that was waived 3 years ago. So today, anybody can designate themselves as an M&A broker. So every year I will get between 25, maybe 30 people that will call me and say, guess what? I left the Bank of Montreal. I'm hanging up a shingle as an M&A guy. And of course, I'll say, good luck, go find a deal. And these guys will batter around in the marketplace looking for their first deal. And even if they find one, they don't know how to do the valuation. They don't know how to put a proper SIM together. They don't know where to find a buyer. For every mergers and acquisitions professional that makes a living, there's probably close to 40 people that raise capital. However, the Ontario Securities Commission have really tightened up. And they said, if you're raising capital today, you have to be what's called a limited market dealer, which means you've got to be registered, and it's a firm registration, and you have to have $25,000 in a bank account as a bond. So lots of people are raising capital, lots of companies looking for money, not many companies that are looking to sell.
So what is a limited market dealer, and what do you have to do to become one, and what can you do when you become one?
Well, as a limited market dealer, first of all, you have to take through the educational program. There's an association. You pass your program, you register, you're approved by the Ontario Securities Commission. You then post a bond. That bond is $25,000, and there's an annual fee, which is pretty substantial, to maintain that registration. That allows you to go out and raise money for either public deals or private deals. A lot of charlatans in the business of raising money. They ask for big fees up front. They ask for retainers to raise capital. So in order not to do that, these limited market dealers have a very, very strict code of how they have to operate, so that they're not taking advantage of people looking for money.
I heard of something called an exempt market dealer.
For money.
What is an exempt market dealer, and how is that different?
They're pretty much the same. The exempt market dealer has the ability to work in public markets as well as private markets. A limited market dealer is restricted to working with private companies, although they can file their registration to do public offerings, just like you talked about the CGAPC. Yeah,
and we won't talk about it in length since you're not active in those markets, but there's two sort of they're public markets, but they're ways that a lot of private companies go public today. In Canada, CPC, which is a capital pool company, which is a structure set up by the Toronto Stock Exchange Venture that allows people to raise effectively blind pools of capital in the public marketplace that then go out and look for acquisitions that they'll do, that they'll allow to do a reverse takeover of them. And there's a trend that you may want to comment on called SPACs, which are special purpose acquisition companies in the United States that are similar. They were actually copies of the CPCs put in place by Obama during his era, and I can't remember what the bill was called. I think it was the restart or something like that. But they put in place these SPACs. The difference with SPACs in the United States, they're similarly blind pools of capital in the public marketplace, but they can have billions of dollars of cash in them versus a couple $1 million in the Canadian CPCs.
SPACs are everywhere. Special acquisition corporations are blind pools. So you have 2 years to go out and make an investment. So I'm in touch with all kinds of large SPACs that have raised $1 billion, and now they're going out looking for an acquisition. So they've raised money from pension funds, insurance funds, high net worth individuals, endowments. They're managing this fund. Their mandate is to go out and make an acquisition or a series of acquisitions. Steve Mnuchin, who was a senior member of the Trump cabinet, has gone out and started a SPAC. He's being supported by a very, very large Japanese corporation. He's raised $2.2 billion so far. Challenge: go find a deal of that size that's available. Lots and lots of money, nothing to buy. Bring me a deal.
What I've heard about SPACs is that it went too crazy, that there were way too many SPACs formed, way too much money raised, and now they're desperate to find the acquisitions. Is that the case?
And they're crawling all over the place. I hear from large SPACs from all over the world, particularly in the US. Spoke to a group on Friday morning from New York, just raised $500 million looking for companies in the medical technology business. Well, guess what? There's about 120 other SPACs looking in the same domain. Lots and lots of money, nothing to buy. However, the valuations as a result of that have gone up. They're prepared to pay more.
But it just doesn't make sense to me. Mark, explain it. So if you invest in a SPAC, number one, your capital is in there with no return for a year or two.
2 years.
Number two, you're going to get a fee that the management's going to charge that's going to lower the amount of capital that's in there. And number three, then they're going to go out and do a deal that may or may not be a spectacular deal. So why would so many pension funds and other people put so much money in SPACs if the probability of success is so low?
Probabilities so far have been pretty successful. I mean, a lot of these SPACs have come out of the market. It's particularly in technology, and they've returned a better return. As I say, you've said it, the pension funds and insurance funds investing in real estate in the stock market are getting minuscule returns. SPACs are acquiring private companies and taking them public. Public returns are significantly better. If I can take a private company and buy it for 5 or 6 times EBITDA, and I can take it to the public, I will probably see somewhere between 18 and maybe 30 times EBITDA just by making that transaction. Public multiples are very high. They're very frothy.
Okay, come on. PE multiples, which are after interest and after tax and after depreciation, are in the 20 to 30 range. How can you get an EBITDA multiple in that 20 to 30 range?
Well, I mean, if I bought it at 5 times, I've raised the capital, I've acquired the company, and I paid 5 or 6 times EBITDA. I have a SPAC or I have a CPC. I can now go public, take it to the public. What are public returns? New companies, if I bought it at 5 and I go to the public, I may get, as I say, 18, 25 times EBITDA. The returns are very high.
Okay, so let's go ahead.
Go ahead. I mean, it's pretty basic. I mean, that's why there's so much money being pushed in this direction. That's why there are over 42,000 private equity firms in the US, all scouring, looking for deals. All, of course, have their own criteria because they're buying it at 5. Many are taking it to SPAC, taking it public. Exit for these private equity firms are to take a lot of these companies public. So there's a lot of new public issues. I mean,
Okay,
check
so
the number
let's
of
talk
new listings.
Let's talk about how people get involved in this. So let's say I'm a small business owner in Mississauga or Brampton or Toronto somewhere,
Wherever.
And I've got between $2 and $10 million of EBITDA, the way you described it, and I want to sell to a SPAC. What do I do?
Well, first of all, doing it yourself is not very easy. You need a professional. So that's what we do. You engage a professional. A professional will do a valuation, set expectations, prepare a proper teaser, which is blind, no names, and a proper information memorandum. There's a cost to do that. However, now you have a presentation. That individual's teaser letter will probably go out to 400 or 500 companies around the world because you want to canvass the market. Values at different places and different groups have different objectives at any given time. So now we've contacted a very wide network of people. We've had all these teasers go out, which are blind. Nobody knows who the company is. We sent out 400 responses. We got back 100. From the 100 now, we've screened it down to say, we've really studied these companies carefully. Who are they? Now we've brought that list down to maybe 25. We signed non-disclosure.
Please continue, Mark.
So let's go back over the process. We have a seller, an interested seller. We sign a non-disclosure document. I do a valuation. I can do you don't need to pay for a valuation. We will offer a valuation to a qualified individual, no cost, no obligation. I will do the valuation in the premises. They can have their accountant. We'll do a rough valuation. If I say the business is worth X and a little, and they say, no, we're looking for 2 times X, no point starting. But if we're on the same wavelength, we now are preparing a teaser letter, a confidential information memorandum, which has all the information about the company. So we only have to do it once. We then take that teaser letter and we may send it out to 400 or 500 prospects around the world. We buy data from a database, which costs us $35,000 a year for a 1-year license. However, we have the names of every single company, every single website, every single email address of companies in that niche. If we're selling a company that manufactures springs, we can find the names of every single company worldwide that would be a strategic suitor. We can also get the information of all the private equity companies that own spring companies, all the endowments that have interest in those markets. So we may qualify and send this blind teaser. It's a description of the company, no names, sent out. 500 letters go out. Bingo. We get 100 back saying we're very interested. We study those 100, carefully screen them. Now we bring it down to maybe 25, maybe less. Say these are qualified groups. Now everybody signs a non-disclosure document. We send out our SIM, and now we get response. These days, the whole process turns into an auction. That is very common. So you're paying one off the middle. Groups that have a greater interest will pay more. So we talked about 5 times EBITDA. In these auctions, you're bidding up. They're paying 7, 8, 9, 10 times if the company obviously qualifies as a company that's in great demand. So there's no black magic to the process. The key is knowing who the logical suitors are, having a qualified client. Then we take letters of intent. We reach the point where we've accepted a letter of intent. Now the due diligence begins. Due diligence now is we've got your SIM, we've got your financial information. Now we need to really dig in and take apart the company and understand. But we've entered into a lockup agreement. So nobody else can bid. We've accepted a deal. Now we're doing due diligence. Due diligence might take 6 to 8 weeks. They have legal due diligence. Is the company properly registered? Are there any lawsuits? Are there any other encumbrances? Are there management issues? They go through all the issues. If that happens, now we work toward a closing. And we do a closing. In a lawyer's office, deal closed, group acquires the business. Sellers generally today will stay for 1 to 2 years. Some sellers say, look, I just want to take my chips off the table, do some estate planning, and I'll stay with the company to run the company. The ideal is that they do stay. So they have owners stay with the company. However, most of these owners don't want to work 5 days a week. Many of these people have been in business for 40 years.
They were entrepreneurs. They don't want to work for someone else, particularly a private equity kid that's going to be calling you every week or day.
Maybe every day. So there's a transition. So these private equity groups are pretty shrewd. They will hire a very senior executive recruiter to find somebody to fill that spot in Canada or the US. So a lot of these companies will have a very, very strong new leader at the helm leading the company. They incentivize these people. The investors on the private equity side and the new management have an opportunity to participate in equity ownership. They get an upside. They get to share. That is the incentive for these companies to continue doing what they're doing.
The market in Canada versus the United States, are they the same, similar, not as great in, not as attractive in Canada? Tell us a little bit about that.
It is pretty much the same. I mean, there are American private equity groups. I mean, they notify people like me every week. We're coming to Toronto. Do you want to meet us? There'll be 5 or 6 groups coming up to look at deals here every week.
Really?
And so you meet, we talk. They all have different objectives. However, they're all here because the market is, the Canadian market was ignored for years. The Americans are crawling all over each other to acquire companies in the US. They're now coming to Canada. Some in Mexico, but Canada is the new place to be.
You mentioned, the lockup. What happens if going through that lockup, you don't decide to go ahead? Are there breakup fees that one has to pay?
Well, in bigger deals, there is a breakup fee. So let's say that we don't go forward, we've stopped the deal, then there might be a breakup fee to say you've got to cover expenses or some penalty for not proceeding with the deal. Deals were going forward. Look, there weren't visits because nobody could cross the border. They can now. We were doing everything by Zoom. We were doing 4 or 5 Zooms a day, right? Day and night. We didn't have to have people traveling here from Germany or traveling here from Atlanta. We did Zoom meetings. Deals have been happening. The law firms are very busy. The accounting firms are very busy. Lots of activity taking place. Problem is, as I say, nothing to buy or very little to buy. Bring me a deal. Bring me a deal.
We're chatting tonight with Mark Borkowski. He's the president of Mercantile M&A. We're going to take a break, a final break, and come back with some concluding comments in just a minute. Stay with us, everybody. Welcome back to the Brian Crombie Radio Hour, Saga 960. We're chatting tonight with Mark Borkowski, who is the president of Mercantile M&A. Mark, if people want to get in contact with you because they've either got a company to sell or they want to get some advice, how do they do that?
Well, they can go to my website or contact me. Mercantile Mergers and Acquisitions website, www.mercantilemergersacquisitions.com.
Mercantile mergers and acquisitions.com. And it sounds like you're pretty busy.
We have never been busier in 34 years in this business. It is crazy at the moment. We're currently actively selling 5 companies. One is in due diligence, soon to be 2. In 34 years, we haven't seen this kind of market, and it's going to continue. It's hot. A great place to be at the moment. A great profession. Hope to make a lot of money this year.
Sounds fantastic. If you were advising a young MBA that wanted to get into your business, what would you say? Would you say
come and join us? Come and join us. I mean, we get a lot of resumes. This is not for the faint of heart. I mean, I eat what I kill. If I close a deal, we make a fee. If I don't close a deal, I carry all the expenses. So we work on a contingency basis. So a lot of these young guys who I'll say, look, if you want to make a lot of money, share the upside with me. So I'll give you a base salary, but share the upside. So if we close the deal, you get a big chunk of the deal. A lot of these people are coming out of these millennials. They want a guaranteed salary and they want to sit there. So I give them the option. You want a guaranteed salary, or I'll give you a base salary. And if we close the deal, wow, maybe you can buy that condominium in your first deal.
You know, it sounds to me, based on this conversation, like the real opportunity is to go out there, be an entrepreneur and create those businesses, run them for a couple of years, get them up to $2 to $10 million in EBITDA, and then come and see you. Because What you're saying is that there's too many people looking for deals, not enough good companies to buy. So let's create some good companies to buy.
Everybody who approaches me that wants to buy a company, a lot of these dreamers, I say, go and start something. And the people that I talked to 5, 6, 7 years ago that I encouraged and even invested with them a small amount of money, these people are ready to sell. These people are overnight in 5 years have become millionaires many times over. They've built something. They've created new wealth. They've created value. Go and start a business. Go and start a business.
Well, you heard it here from Mark Borkowski, the president of Mercantile Mergers and Acquisitions. Go and start a business.
Right on.
It sounds
Thank
like
you, Brian.
What was that movie, The Graduate, where he said the future is plastics?
Exactly. Still is.
The future is start a business.
Everything.
You heard it here.
The hottest places to be are heating, ventilating, air conditioning, the insurance brokerage industry, any of the trades, anything in manufacturing. Anything manufactured in Canada at the moment is hot.
That's our show. That's our show for tonight, everyone. Mark, thank you so much for joining us. And you heard it from Mark. Go out and start a manufacturing business.
Let's do it. Call me.